Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts that we're watching this hour. First up, markets rallying off the back of reports that tariffs on China could be dialed back by as much as 50%. We'll get you those latest headlines and discuss whether this relief rally could last. Plus, Treasury Secretary Scott Bessent is expected to speak this morning after saying the trade war with China is set to de-escalate. We'll bring you those headlines and those remarks live. And tracking moves in FX. We're watching an attempted recovery in the dollar after a slide to multi-year lows. What's next for the world's reserve currency? Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages soaring to the upside off the back of that reporting from the Wall Street Journal indicating the White House officials are encouraging a staggered approach to tariffs with regards to China. You've got your S&P up over 3%, your tech-heavy NASDAQ up about 3.8%. Consumer discretionary driven by Tesla is the biggest gainer in the S&P. Back behind it is information technology as the second biggest gainer here. Let's take a look over at the bond market because it's been interesting to watch those moves. Bonds catching just a bit of a bid here. The 10-year down about a couple basis points here, and same with your 30-year yield. Interesting to see that the composite PMI data came in a little bit worse than forecast, but better than feared. So perhaps avoiding those recessionary concerns, especially as we see those tariff headlines coming in. We're going to continue to discuss that possibility throughout our programming. And finally, let's take a look over at Bitcoin moving to the upside, holding above that 90,000 level, up over 3% this morning. Here with more, I want to bring in Chris Versace. He's the Chief Investment Officer and Thematic Strategist at Thematica Research. Chris, great to have you back. These headlines that we are getting in about the Trump administration, White House officials potentially dialing back tariffs on China, obviously a huge rally happening in the market off the back of those headlines. Does that rally have sticking power?
I think it's a relief rally, right? People were so concerned about the impact of that, the impact of the economy, the impact of earnings, guidance that we'll be getting over the next couple of weeks. So to me, it's more of a relief rally. But I think that when you talk about dialing it back by 50%, that still means 70+% tariffs, right? So there's still going to be an impact. I think we'll have to game out and see exactly where these new round of potential tariffs go. But at the same time, what is China's response to this? Mm-hmm. They have reciprocal tariffs on us. Are they willing to, quote, play ball?
Yeah.
We'll have to see.
We certainly will have to see. But we are hearing from Treasury Secretary Scott Bessent about these tariffs and the potential relationship with China. He is speaking live right now. Let's listen in.
In the final months of World War II, Western leaders convened the greatest economic minds of their generation. Their task, to build a new financial system. At a quiet resort high up in the mountains of New Hampshire, they laid the foundation for Pax Americana. The architects of Bretton Woods recognized that a global economy required global coordination. To encourage that coordination, they created the IMF and the World Bank. These twin institutions were born after a period of intense geopolitical and economic volatility. The purpose of the IMF and the World Bank was to better align national interest with international order, thereby bringing stability to an unstable world. In short, their purpose was to restore and preserve balance. This remains the purpose of the Bretton Woods institutions. Yet everywhere we look across the international system today, we see imbalance. The good news, it doesn't have to be this way. My goal this morning is to outline a blueprint to restore equilibrium to the global financial system and the institutions designed to uphold it. I have spent the bulk of my career from the outside looking in on financial policy circles. Now I am on the inside looking out. I am eager to work with each of you to restore order to the international system. To achieve this, however, we must first reconstruct the IMF and World Bank reconnect the IMF and the World Bank with their founding missions. The IMF and World Bank have enduring value. But mission creep has knocked these institutions off course. we must enact key reforms to ensure the Bretton Woods institutions are serving their stakeholders, not the other way around. Bringing balance back to global finance will require clear-eyed leadership from the IMF and World Bank. This morning, I will explain how they can provide that leadership to build safer, stronger, and more prosperous economies all around the world. I wish to invite my international counterparts to join us in working toward these goals. On this point, I wish to be clear. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system. Nowhere is the imbalance I mentioned earlier more obvious than in the world of trade. That's why the United States is taking action now to rebalance global commerce. For decades, successive administrations relied on faulty assumptions that our trading partners would implement policies that would drive a balanced global economy. Instead, we face the stark reality of large and persistent U.S. deficits as a result of an unfair trading system. Intentional policy choices by other countries have hollowed out America's manufacturing sector and undermined our critical supply chains, putting our national and economic security at risk. President Trump has taken strong actions to address these imbalances and the negative impacts they have on Americans. This status quo of large and persistent imbalances is not sustainable. It is not sustainable for the United States, and ultimately, it is not sustainable for other economies. Now, I know sustainability is a popular term around here, but I'm not talking about climate change or carbon footprints. I'm talking about economic and financial stability, the kind of sustainability that raises standards of living and keeps markets afloat. International financial institutions must be singularly focused on upholding this kind of sustainability if they are to succeed in their missions. In response to President Trump's tariff announcements, more than 100 countries have approached us, wanting to help rebalance global trade. These countries have responded openly and positively to the president's actions to create a more balanced international system. We are engaged in meaningful discussions and look forward to talking with others. China in particular is in need of a rebalancing. Recent data shows the Chinese economy tilting even further away from consumption toward manufacturing. China's economic system, with growth driven by manufacturing exports, will continue to create even more serious imbalances with its trading partners if the status quo is allowed to continue. China's current economic model is built on exporting its way out of its economic troubles. It's an unsustainable model that is not only harming China, but the entire world. China needs to change. The country knows it needs to change. Everyone knows it needs to change, and we want to help it change because we need rebalancing too. China can start by moving its economy away from export overcapacity and towards supporting its own consumers and domestic demand. Such a shift would help with global rebalancing that the world desperately needs. Of course, trade is not the only factor in broader global economic imbalances. The persistent over-reliance on the United States for demand is resulting in an ever more unbalanced global economy. Some countries' policies encourage excess savings, which holds back private sector-led growth. Others keep wages artificially depressed, which also suppresses growth. These practices contribute to global dependence on U.S. demand to spur growth. They also lead to a global economy that is weaker and more vulnerable than it should be. In Europe, former ECB President Mario Draghi has identified several sources of stagnation, and he has outlined several recommendations to get the European economy back on the right track. European countries would do well to take his recommendations to heart. Europe has already taken some long overdue initial steps that I applaud. These steps create a new source of global demand and also involve Europe stepping up on the security front. I believe global economic relationships should come to reflect security partnerships. Security partners are more likely to have compatible economies structured for mutually beneficial trade. If the United States continues offering security guarantees and open markets, then our allies must step up with stronger commitments to shared defense. The initial actions from Europe on increased fiscal and defense spending are proof that the Trump administration's policies are indeed working. The Trump administration and the U.S. Treasury are committed to maintaining and expanding U.S. economic leadership in the world. This is especially true at the international financial institutions. The IMF and World Bank serve critical roles in the international system, and the Trump administration is eager to work with them so long as they can stay true to their missions. And under the status quo, they are falling short. The Bretton Woods institutions must step back from their sprawling and unfocused agendas, which have stifled their ability to deliver on their core mandates. Going forward, the Trump administration will leverage U.S. leadership and influence at these institutions and push them to accomplish their very important mandates. The United States will also demand that the management and staffs of these institutions be accountable for demonstrating real progress. I invite all of you to join us in working to refocus these institutions on their core missions. It is in our collective interest to do so. The IMF. First, we must make the IMF again. The IMF's mission is to promote international monetary cooperation, facilitate the balanced growth of international trade, encourage economic growth, and discourage harmful policies like competitive exchange rate depreciation. These are crucially important functions to support the U.S. and global economies. Instead, the IMF has suffered from mission creep. The IMF was once unwavering in its mission of promoting global monetary cooperation and financial stability. Now it devotes disproportionate time and resources to work on climate change, gender, and social issues. These issues are not the IMF's mission. And the IMF's focus in these areas is crowding out its work on critical macroeconomic issues. The IMF must be a brutal truth teller and not just to some members. Today, the IMF has been whistling past the graveyard. Its 2024 external sector report was entitled Imbalances Receding. This Pollyannish outlook is symptomatic of an institution more dedicated to preserving the status quo than answering the hard questions. Here in the United States, we know we need to get our fiscal house in order. The last administration ran up the largest peacetime deficit in our nation's history. The current administration is committed to fixing this. We are open to critique, but we will not abide the IMF failing to critique the countries that most need it, principally surplus countries. In line with its core mandate, the IMF needs to call out countries like China that have pursued globally distorted policies and opaque currency practices for many decades. I also expect the IMF to call out unsustainable lending practices by certain creditor countries. The IMF should push more proactively official bilateral lenders to come to the table early to work with borrower countries to minimize periods of debt distress. The IMF must refocus its lending on addressing balance of payment problems, and its lending should be temporary. When done responsibly, IMF lending is at the very core of its contribution to the global economy. When markets fail, the IMF steps in and makes resources available. In exchange, countries implement economic reforms to resolve their balance of payments issues and support economic growth. The reforms undertaken during these programs are some of the IMF's most important contributions to a strong, sustainable, and balanced global economy. Argentina is a fitting example. I was in Argentina earlier this month to demonstrate the United States support for the IMF efforts to help the country reset financially. Argentina deserves the IMF support because the country is making real progress toward meeting financial benchmarks, but not every country is so deserving. The IMF must hold countries accountable for implementing economic reforms, and sometimes the IMF needs to say no. The organization has no obligation to lend to countries that fail to implement reforms. Economic stability and growth should be the markers of the IMF's success, not how much money the institution lends out. World Bank. Like the IMF, the World Bank must be made fit for purpose again. The World Bank Group helps developing countries grow their economies, reduce poverty, increase private investment support, private sector job creation, and reduce dependence on foreign aid. It offers transparent and affordable long-term financing for countries to invest in their own development priorities. The bank, along with the fund, provides extensive technical support to promote debt sustainability among low-income countries, which empowers those countries to stand up to coercive and opaque lending terms from other creditors. These core functions of the World Bank complement the Trump administration's efforts to foster safer, stronger, and more prosperous economies in the United States and the world. But the bank, like the IMF, has strayed in certain respects from its initial mission. The bank should no longer expect blank checks for vapid, buzzword-centric marketing accompanied by half-hearted commitments to reform. As the bank returns to its core mission, it must use its resources as efficiently and effectively as possible. And it must do so in ways that demonstrate tangible values for all member countries. The bank can use its resources more efficiently now by focusing on increasing energy access. Business leaders the world over identify unreliable power supply as one of the primary impediments to investment. The World Bank and African Development Bank's Joint Mission 300 initiative to expand energy access to 300 million more people in Africa is a welcome effort. But the World Bank must respond to countries' energy priorities and needs and focus on dependable technologies that can sustain economic growth rather than seek to meet distortionary climate finance targets. We applaud the recent announcement that the World Bank will seek to remove prohibitions on support for nuclear energy, which could revolutionize energy supply for many emerging markets. We encourage the bank to go further in giving countries access to all technologies that can provide affordable baseload generation. The World Bank must be tech neutral and prioritize affordability in energy investment. In most cases, this means investing in gas and other fossil fuel-based energy production. In other cases, this may mean investing in renewable energy coupled with systems to help manage the intermittency of wind and solar. The history of humanity teaches a simple lesson. Energy abundance sparks economic abundance. That's why the bank should encourage an all-of-the-above approach to energy development. Such an approach will make World Bank financing more effective, and it will reconnect the bank to its core mission of economic growth and poverty alleviation. In addition to increasing energy access, the World Bank can use its resources more effectively by starting to apply its graduation policy. This would allow the bank to focus on lending to poorer, less creditworthy countries. This is where World Bank support makes the biggest difference for poverty and growth. Instead, the World Bank continues to lend every year to countries that have met the criteria to graduate from World Bank borrowing. There is no justification for this continued lending. It siphons off resources from higher priorities and crowds out the development of private markets. It also disincentivizes countries' efforts to move away from dependency on the World Bank and toward job-rich, private sector-led growth. Going forward, the bank must set firm graduation timelines for countries that have long since met the graduation criteria. Treating China, the second largest country in the world, as a developing country is absurd. While it has been at the expense of many Western markets, China's rise has been rapid and impressive. If China wants to play a role in the global economy commensurate with its actual importance, then the country needs to graduate up. We welcome that. The World Bank should also implement transparent procurement policies based on best value. It must help countries move away from procurement approaches that prioritize only the lowest cost bids. Such procurement policies reward distortive and subsidized industrial policies that undermine development. They may also stifle the private sector and incentivize corruption and collusion and result in greater long-term cost. Procurement policies based on best value are better from both an efficiency and development perspective, and their robust implementation will benefit the bank and its shareholders. Related to this subject, I wish to send a strong, and I emphasize strong, message about procurement policies as regards Ukraine. No one who financed or supplied the Russian war machine will be eligible for funds earmarked for Ukraine's reconstruction. No one. To conclude, I invite our allies to work with us as we rebalance the international financial system, refocus the IMF and World Bank on their founding charters. America First means we are doubling down on our engagement with the international economic system, including at the IMF and the World Bank. A more sustainable economic system will be one that better serves the interests of the United States and all the other participants in the system. We look forward to working with all of you in this endeavor. Thank you.
That was Treasury Secretary Scott Bessent speaking this morning. Just want to get through a couple of the headlines coming from this conversation. Treasury Secretary saying he's in conversation as part of the Trump administration with 100 countries, saying China can start reforms. And we're getting that Q&A with Treasury Secretary. Let's listen back in.
It's very meaty, comprehensive set of remarks, but you say, I wish to be clear, America First does not mean America alone. To the contrary, far from stepping back, you seek to expand U.S. leadership in international institutions like the IMF and World Bank. I must say there's a collective sigh of relief across this town right now because the concern coming into this week is that you were going to do exactly what you said you're not going to do, which is the U.S. would withdraw. But you want to lead. What you're asking for is simply getting back to factory settings, right? Focused approach and deal with the issues that you see are most paramount, correct?
Correct. As I said in my confirmation hearings, I think U.S. engagement with the international financial and multilateral institutions, we should engage and we should be in it to win it for the American people and for the rest of the countries and for the client countries.
20 years ago, a senior U.S. Treasury official gave a speech very similar to this, calling on the IMF and said the IMF was asleep at the wheel and dealing with imbalances. Hank Paulson started the Strategic Economic Dialogue with the Chinese. Every Treasury Secretary since then have had an approach. So how will you do this differently, and how do you think that you'll proceed in this approach? What is your philosophy? What is your tools, and how will you execute on this?
Well, look, I think that our move toward reordering the financial or trading system is a start. I think that today, as I reaffirm our engagement, but set up a list of core principles and back to basics for the institutions, and again, being from the private sector, we want to see results. And we want to see timelines that, as you and I were talking about backstage, global rebalancing has been a topic for more than 20 years.
Long time.
And it's, some countries may have a 100-year perspective. We don't.
Right. China obviously is an important part of this administration's foreign and economic policy. You'll be meeting with your Chinese counterparts. What will you tell them in the sense of how they obviously are aware that there's huge imbalances, their manufacturing capacity is enormous, especially in things like automobiles. How will you help them understand that it's not just about talking, it's about executing?
Well, look, I don't think I have to help them understand. I think they understand very well. And it's just a matter of impetus and will. So I believe I first went to Japan in 1990, 91, within 12 months of the peak of the bubble, a decade of that unwind, a decade of malaise. And then in 2012, I ran across a fellow, 2011, who was running for prime minister named Shinzo Abe, and he knew that Japan needed change and implemented it very quickly. 10 years later, more than 10 years later, Japan has had a remarkable economic run. And I think that our Chinese counterparts that will come to this realization, and if some of our policies, sometimes it takes an external push.
Right.
Alternatively, what I have said previously, there is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together. This is an incredible opportunity. And I think if Bridgewater founder Ray Dalio were to write something, he could call it a beautiful rebalancing.
Indeed. But a big part of that will also be our own fiscal imbalance. And as you mentioned, we're running deficit 6% of GDP at the top of the cycle. Not sustainable, as you yourself have pointed out. How important is it to also address our fiscal imbalance as part of this larger rebalancing?
Well, it's very important that I think most people in this room are trained economists, and everyone knows that a trade deficit emanates from three things. External trade policies, which we are intent on addressing, and the external trade policies can be tariffs, non-tariff barriers, currency manipulation, and the state subsidy of labor and means of production. Mm-hmm. So terms of trade or trade regulation is one. Two is our budget deficit. So the larger our deficit, the more it creates a demand suck, also pushes up the interest rates. And then 3, the level of the dollar. The U.S., we continue to have a strong dollar policy, and the dollar will adjust based on markets. Everyone asks me, well, what does a strong dollar mean? And to me, the strong dollar means having the policies in place to deserve capital flows and have confidence. But it doesn't mean that the price on the Bloomberg screen every day. And it also has different meanings in terms of bilateral the prices. So it's really 3-pronged. But Tim, to your question, I have talked about we did not get here quickly with the spending. The U.S. does not have a revenue problem. We have a spending problem. And I have suggested when I first met President Trump to talk about joining his campaign 2 years ago that we need to get back to a long-term sustainable budget deficit of something with a 3 in front of it, which works. We have 2% nominal growth or 2% inflation, projected 1.8% growth, which I think could be much higher if we implement our economic policies.
You reaffirmed the strong dollar policy first articulated by Bob Rubin. Valerie Giscard d'Estaing in the 1960s talked about the U.S. exorbitant privilege of the dollar. There are some in this town who question that privilege and actually see it as a burden. Do you see it as a privilege?
That the U.S. sits at the center of the global economy is enabled by the use of dollars, and that it's natural that the usage would come down over time. And I think that the U.S. will always, for my lifetime, be the reserve currency. I actually am not sure that anyone else wants it. I can't remember, one of the European officials said today, maybe it was Mr. de Guindos, I can't remember, said, oh, well, the euro could become a second reserve currency. We've just had a substantial appreciation in the euro. For export economies, it's a lot of pressure. And look, I think that the reaffirming our belief in these international institutions is also part of that.
You mentioned the euro. You mentioned in your comments Mario Draghi's report from last year. There was the letter report. Before that, I've been spending a lot of time in Europe. There does seem to be a much more buoyant atmosphere in Europe. They see this as an opportunity for them. I said something about a possible renaissance. I was heckled a bit, but I actually am pretty positive on Europe. Do you think this is an opportunity to shift some of that demand? The world has relied on U.S. final demand to shift some of that demand for Europe. Is this a positive time for Europe?
Look, I think it can be, and it wasn't in a straight line. It wasn't always the way a trained diplomat would have done, but I think we should all congratulate President Trump. He has done what a succession of European leaders have tried to do for the past 26 years, since the advent of the euro, that whether it's the French, the Italians, other European countries have tried to get Germany to increase their fiscal spend and drive the European economy. And that I applaud these nascent efforts because it's a combination. It's a combination of economic stimulus, and it is a combination of burden sharing on the European continent for defense. And as I've said many times before, economic security is national security is economic security. So if this European plan works, that I applaud it. I had a private meeting with the Spanish finance minister last week, 2 weeks ago, and he said, you're going to be pleasantly surprised with where we go on military spending, and that this 2% number today, he was right.
Yeah. So you're already taking on these tasks. You have China, more consumption, less investment, deal with their manufacturing excess capacity. Europe's a great opportunity.
And we are just hearing from Treasury Secretary Scott Bessent, really sticking out to me. He said, America first does not mean America alone. A key tonal shift from this administration sounds different than what the market was fearful of, that there was going to be this stark U.S. withdrawal from the global phase. Treasury Secretary Bessent making it seem as if there is more room for negotiation than investors may have feared. You're seeing stocks rallying off the back of these remarks. Just to go through a couple of the headlines here, talking about how there is opportunity for a big deal between the U.S. and China. Again, his remarks coming off the back of that reporting that there is that potential negotiation down to half of what the previous China proposed tariffs were looking like. Also some insight in terms of the goals of this tariff policy, talking about national security, manufacturing, but primarily a global rebalancing, putting this "we want to help China" narrative out there, saying we want to help them become a more balanced economy, treating them like a true competitor on the global stage here, and talking about how some countries may have a 100-year perspective. We don't. That indicating to me that these tariff negotiations, while they may be better than the market feared in terms of end result, they are still a priority for this administration. Also talking about a continued strong dollar policy and what that means for markets moving forward. We'll continue to get you these headlines, but sticking with me to break it all down, we've got Chris Versace from Tematica Research. Also joining us, Francesco Persoli, ING FX strategist. And I want to go to you first here, Chris. What stood out to you from these remarks?
You know, I think the comment that you just highlighted, that we're not going to do this alone as America. We will go first, but it tells us that we want to work with our partners, but also redraw trade lines. And I think if we dial back to what Trump was, originally trying to do before the tariffs got out of control, I think he wanted to lower tariffs on U.S. products for inside of other countries to help grow U.S. exports. Sounds like we're coming back to that.
It certainly does. Francesco, I want to go to you on this. I can't wait to get your take on what the Treasury Secretary just said about the price of the dollar. It's not what you see on the Bloomberg screen. What did you take that for?
It's not the first time, really, that Bessent talks about the importance of retaining the sort of strong dollar policy. We must remember that the original plans by the Treasury, in theory, was that the first reaction of the dollar to tariff announcement would be a strong dollar that should have helped insulate U.S. consumers from higher prices from tariffs. And obviously, the fact that we saw this sort of loss of confidence in the dollar and the dollar sell-off in actually right after Liberation Day is not something that probably Bessent was happy with. And I believe that there is an ongoing attempt to reestablish at least some stability in the dollar for the period that the first inflationary hit will occur in the U.S. and then only look at sort of weaker dollar for export sort of advantages at a later stage.
Francesco, obviously you are an expert in global currencies, but I want to get your geopolitical hat on this. Bessent saying that the U.S. wants to help China pivot away from an export-first economy. How do you read that? Do you think that the U.S. has overplayed its hand when it comes to China?
Well, I'm not sure that there is much interest in Beijing to sort of allow the U.S. to sort of drive a transformation domestically in terms of sort of the whole business model. I mean, when we look at what China has been trying to do is that they are also trying to slowly migrate away from the export-only model. So I'm not sure they would be able to do it or willing to do it at the conditions that the U.S. may want to set there. But I think what's really important is that China had already started sort of transitioning away, especially when it comes to cheap manufacturing. They want to specialize more on new technologies and on AI. They're trying to push in that direction, as well as electric vehicles, which is another big factor. I think this is already happening and will be happening regardless of the role of the U.S.
And for our audience just tuning in, want to take a listen to what Treasury Secretary Scott Bessent had to say about tariff policy. Take a listen.
I wish to be clear. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
I also think it's interesting to point out that he was talking about leaning into some of these global groups, including the IMF and the World Bank, because there was some concern about a U.S. isolationism more broadly. But Chris, I want to go to you on the market action. We're continuing to see stocks rallying off the back of these remarks, and I want to know how sticky this can be. Can investors believe in this rally?
Again, I think there's going to be a lot of details that we're going to get. Where are we going with those China tariffs that got the market so excited this morning? What's the China response to this? We've been in kind of a very tightly woven trading market. Some folks would say, buy the dips, sell the rips. Whether or not we break out into a more sustained rally, I think what we learn in the coming days is going to tell us.
It certainly is. And also just getting a couple more headlines in from Treasury Secretary Bessent talking about substantial appreciation of the euro, also saying private credit is an interesting addition to U.S. capital as he answers questions after his remarks. We'll continue to get you those headlines. You've got your S&P 500 up over 3%, your tech-heavy NASDAQ up over 4%, a huge relief rally happening in markets this morning. Francesco and Chris, thank you both so much. Coming up, we're going to take a look at the latest ETF flows and how risk-off investors are repositioning. Stick around. Large cap U.S. equity ETFs all rising alongside the broader market, coming off of reports that the White House is considering cutting its tariffs on China. Will today's rally give ETF investors their appetite for more risk? Or is this a shift towards safe haven assets that's here to stay? I want to bring Noel Archer, AllianceBernstein Global Head of ETFs and Portfolio Solutions, for this week's ETF report brought to you by Invesco QQQ. Noel, great to have you on here. Obviously, we are seeing a huge relief rally in the markets. You've got your NASDAQ up now over 4% this morning, but you note that investors have continued to be buying throughout some of the volatility that we've seen. Talk to me about where that leaves us today. Do investors have the necessary capital on hand to continue to buy into this rally?
Yeah, I think that's one of the interesting pieces. We've talked about this before. There's still a lot of cash on the sidelines. People have been keeping some powder dry as we've moved, really through the last year, frankly. I think what's, it's the old Mark Twain quote about New England. If you don't like the weather in New England, wait a few minutes. That's how it feels like with these market conditions lately. So it's nice to see the relief rally. We have to see where it goes. I think what we've seen on that appetite is we're continuing to see flows into ETFs. First quarter was, again, tracking towards maybe another record year, softened up a little bit as we went through April. As far as the amount of flows and what it was going into, but a bit of a pivot into fixed income, a little bit of a pullback from equities. But as of yesterday, that started to reverse itself as a little bit of the, I won't say that the concerns about the Buy America trade is over, but we're starting to see some early signs of life. But to say early is an understatement, right? It's been a couple of days, and I think investors want to see how this plays out.
They want to see how it plays out, but they've also been repositioning along the way. So I wonder if you can talk a bit about that. How much of a reallocation have you seen out of U.S. stocks? Yeah,
well, I think that it's driven by a few things. We're seeing, for the first time in a decade, we're actually seeing some good returns outside of the U.S., driven by a number of factors, some because of investments by companies in Europe, and some just by the conditions that we've been dealing with in the U.S. So you're seeing flows going into developed market and emerging market exposures. You're seeing a shift a little bit from equity and going into the short end of the fixed income markets, particularly the ultra short. Again, that's a bit defensive. You're still getting decent yield, but you're not as exposed to big moves in sort of market pricing. So that's been positive. But you also are seeing some interesting spots of life, high yield, where there's still this view of, depending on which way the markets go, it's still important to generate income for the portfolio. And so we're seeing some flows go back into high yield. And then we're seeing your normal safe havens like gold. Gold flows have also spiked up in the last few weeks.
Yeah, that's going to be fascinating to watch. We've seen gold coming back in just a bit this morning as we get a little bit of a risk on bid in markets here. Just curious if you can talk about bonds versus cash has been on my mind over the past couple of days here. To what extent are you finding investors acting a bit skittish on the bond market at this moment?
I think, what we saw over the, I think, we talked about it earlier. It's sort of that, buy the rumor, sell the news. And so this feeling of like, okay, the treasuries are being dumped and we're seeing equities go down, we're seeing treasuries go down. But the view, I think, is shifting around to, we don't really know what the second half of the year is going to bring entirely. If it is a little bit softer, or if companies start to revise some of their expectations down a bit, and maybe, if there is a deal reached, that won't be the reality. But bonds still provide good buoyancy in the portfolio. Shifting into that fixed income posture, taking advantage of some of these yields, is a place that you would naturally go to if you think there's going to be a slowdown in growth.
It's interesting to see that Treasury is catching just a bit of a bid as we are getting that risk on sentiment in markets. Maybe investors taking an opportunity to sell a bit of stock in the rally, get into Treasuries if they weren't. Interesting to see how that market action plays out on the tape. And Noel, thank you so much for joining us. Really appreciate it.
Thank you.
We're going to have all your markets action ahead. Stick around for more. You're watching Catalysts.
I wish to be clear. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
Treasury Secretary Scott Bessent speaking moments ago, expressing plans to restore equilibrium to world financial markets, while small business owners are seeking certainty about the future. What do Bessent's comments signal for the cohort? Joining us now with more, Elizabeth Gore, the co-founder and president of Hello Alice. Elizabeth, great to have you in studio with us this morning. Talk to me about this commentary from the Treasury Secretary, and more broadly, what's standing out to you about the impact to small businesses?
Yeah, howdy. Thanks for having me on. I think between this speech and the one he gave on April 9th, his whole objective said that the global economic policy is really going to be about incentivizing Main Street, which is what I really care about. And so I've been thinking a lot about how would that actually work? And he also mentioned, though, that he wants to incentivize banks to lend locally in a stronger way. So we're talking global, but it has to filter down to Main Street. And so actually his previous speech gave me more optimism than today.
Well, I wonder how optimistic you are about some of these headlines we got this morning as well. The Wall Street Journal reporting that some of the tariffs on China could be cut by as much as half as what was previously anticipated, obviously not confirmed yet. But how big of a deal could that be?
It's a huge deal. I mean, there's a U.S. veteran-owned business called Busy Baby, and they finally got their product into Target, into Walmart, U.S. veteran-owned. However, a lot of the parts for that are manufactured in China. When it went up supposedly 144%, it literally stopped her business. There is no business planning that could fix that in 4 weeks. And so I'm very optimistic that we can pull back on some of this and also delineate between corporate impact and small business impact. Because I do think there are ways to bridge what will be some tough times for those small businesses.
Do you think the idea that only the Walmarts of the world can have a seat at the negotiation table, that's wrong?
No, listen, if you want to meet with a congressman on the Hill, you take a small business with you. They will want, from their community, their local dry cleaner, their local coffee shop, they have a massive voice because that is your neighbors, your friends, your family members, and there is a personal impact and relationship there. So I do encourage, while I know we're all time poor as business owners, email your congressperson, talk to your local district offices. It does matter.
I think that's such important perspective, and I know that these are the kind of perspectives you're going to bring to us on your new podcast. Talk to me a little bit about that. What can we expect?
Oh, we're so excited. We launch tomorrow at 5 p.m., The Big Idea. So you'll find us on podcast, on streaming, and we're going to learn from some of the best business owners in our country. Every week, they are both going to tell their aspirational, inspirational American dream stories, but they're also going to distill down really important points on how to launch and grow your business. 99% of businesses in this country are small. They are also the largest percentage of employers.
Right.
We always think of big corporate. So bringing this with both a finance lens, a storytelling lens, and do you know the most trusted group in America right now are small business owners?
Oh,
Isn't that amazing?
that.
Firemen and small business owners
Oh, I
are
love
hand in
that.
hand. And so I'm so excited that Yahoo Finance and Hello Alice are bringing this story to light.
Well, I know that we are very excited to have it, and to your point, such a key driver of our economy. So really appreciate you bringing us your insights, for coming in studio today, as well as Elizabeth Gore. You can catch new episodes of The Big Idea with Elizabeth Gore every Thursday on Yahoo Finance or wherever you get your podcast. Be sure to check it out. 90 minutes into the start of U.S. trading. Let's get a final check on the markets for you for this hour. That relief rally still soaring. You've got your S&P up over 3%, led in part by tech, also consumer discretionary with Tesla there. Your tech-heavy NASDAQ up nearly 4% off the back of those reports that the China tariffs, they might not be as bad as investors had previously thought. We've also got the bond market yields coming in just a bit. Coming up, we've got Wealth, dedicated to all your personal finance needs. Brad Smith has you for the next hour. Stay tuned for more.